This is Right on the Money with Tom Mosley, founder of Mosley Wealth Management.
Our mission at Mosley Wealth Management is to help people make sure they never run out of income the rest of their life and they pay as little as they're legally required to pay in taxes.
Since 1995, Tom Mosley and his team have been creating comprehensive, custom financial plans to help you preserve what you've earned and pursue what you've envisioned.
In retirement, a lot of people have built a great lump sum. We call that your lumber yard. But you need a blueprint to put that lumber yard into a plan that you can build a retirement house to live in.
What's on your mind this week, Southern California? The stock market, taxes, inflation, income, Social Security, how to ease into the life of your dreams? Let's discover conservative financial strategies starting right now. This is your Right on the Money Radio Hour with Tom Mosley.
And a very happy weekend to you. You are listening to Right on the Money with Tom Mosley. He is the founder and president of Mosley Wealth Management based right here in Southern California. And I'm your host, Kristin Oakley. Each week, Tom and I are committed to providing you with retirement planning solutions. We've got another great show for you this weekend. But before we dive in, Tom, my friend, I know you have some exciting things coming up. Why don't you share with our listeners what you're looking forward to?
Hey, I'm about to go to Europe for about 2.5 weeks. So I am really looking forward to that. It's like a redo of my bucket list. My bucket list was 2019 when I got to go to Italy, and my wife and I are going back to Rome and 𝗕𝗶𝗴𝗴𝗲𝗀𝗃 and Florence, and then we're going to take a little float down the Danube River to Budapest from Munich. So we're really excited. We've been saving. We've been packing away for this. I know what it's like when people, Kristin, sit across the table and they've got that bucket list and that thing they're excited about doing. And we're really excited about going in a few weeks here, in a couple of weeks.
Yes. Well, I'm excited for you all too, to be able to just unplug. You work so hard, and I know it's hard to be away from your clients and doing what you love, but it's so important to have that time away to enjoy as well.
You know, it's funny. I tell my staff, I say, you know, if you need me while I'm gone, go ahead and send me a detailed question. And in the last paragraph, turn in your resignation. You know, because in other words, don't bother me while I'm gone. And that is one thing I have to bring up, because I don't think we make enough out of this. But I have 14 staff members, and we've got one of the best cultures, one of the best group of people. They're a team. They work together. They love our clients, and they love each other. And so when I go away, they can contact me if they need to for something urgent, but they can handle things that are urgent because they're really, really good.
Yes. And it was such a joy for me to get to come and actually see your office space and get to meet with everyone. And I can attest to that. What a wonderful, welcoming environment you've created.
Hey, thank you so much. I'm really proud of it. I'll say it that way. And I also understand with human beings, it's volatile. So you have to keep working on it and making sure that it stays that way every day.
Yes. Well, and just remind our listeners, because I know a lot of folks are newer to you, about all the different locations that you have throughout Southern California.
Yeah, we're sprinkling. And I say that's like we're in the active tense of continuing to sprinkle all over Southern California offices. Our main office has always been here in Anaheim, right across the street, literally, from Anaheim Stadium. But we have offices in Ontario, close to the airport. We have offices in Arcadia, right on Huntington Drive, right off the 210 freeway. And we have a brand new office up in Encino. And it's it's about 1.5 miles, 2 miles from the intersection of the 405 and the 101. And the reason we sprinkle out that way, and our Scripps Ranch office down in San Diego, is we really want to try to be close enough to people so you all can come in and see us. You know, people always say, no matter what we say on this show, Kristin, they call in and they say, send me a blueprint. Well, for us to put a blueprint together, we've got to spend some time with you to see what's in your lumberyard, and that's your 401ks and your IRAs, and see what you've saved. And once we do that, we can put together a blueprint, and usually that's comes after sitting down in one of our offices. And I'll go out on a limb and tell you that within the next 6 months, we're going to have an office in West LA. And we're also going to have an office in northern San Diego County. So once we get to those 7 offices, we feel like we'll be sprinkled enough over the majority of the Southern California area, and we've got 7 advisors and adding a couple in the next month or so. And those 7 advisors go out, see people in those offices, meet with people in those offices, build blueprints, help people every single day.
Yes, well, it's so exciting to see all the expansion and what you have going on. And of course, a lot of folks are also connecting with you virtually. I know you've had some clients reach out to you all the way from across the coast, all the way across the country.
Through our YouTube channel. And you need to check out that YouTube channel. Go to YouTube and then just punch in Mosley Wealth Management, and you can see over 100 YouTube shows and podcasts that we've got on there on almost every subject, the subjects that we talk about. And sometimes we can't go deep enough on the weekend on our TV shows and our radio shows. We're able to really dive into those things on the YouTube channel. So go to that YouTube channel, Mosley Wealth Management, once you get into YouTube. And when you get in there and you watch something, hey, like it, subscribe, so you'll know when we add one each week, and make a real positive comment if you need to, if you can. If you got a negative comment, I always used to say when I ran youth camps, go tell it to a tree. But in reality, if you've got a negative comment, please, email me at info@mosleywealthmanagement.com. We'd certainly be glad to address those and help you in any way we possibly can.
Several ways to connect. And of course, we love connecting with all of you each and every week through this radio show as well. And today we are going to pick back up with a conversation we started last week on the biggest hidden retirement costs. And the whole point of this show, Tom, we said this last week too, is this is folks' golden years. And we want people to be able to relax and enjoy life in retirement. But the reality is there are several hidden costs that can catch you off guard and potentially derail your financial security. And really, today's retirement landscape is often not as straightforward as it seems or as it used to be for previous generations. And really what we want to do today is pick up with the remaining list of these hidden retirement costs and help you know how you can stay ahead of them. Because really what we want to do is what, Tom?
Hey, we want to make sure you never run out of money the rest of your life. I promise you that. And that can really derail you with hidden cost.
Yeah. And we want you to keep your gold in your golden years, right?
Oh, yes.
That's what you had said last week. I wanted to tee that up for you.
I love it. I love it when you pick up on things that I say that I just sometimes say without thinking about them. And you see that they really do resonate out there, right? If they're golden years, you want to keep the gold in them. So I think that's great.
Well, for sure. Well, before we dive back into this list of the biggest hidden retirement costs, there was a recent article that came out that I know you wanted to talk about today regarding net worth for retirees. So why don't you set this up, the context of this article for our listeners?
Okay, the article came out in Go Banking Rates. And the title of the article was Net Worth for Retirees, How to Tell Whether You're Poor, Middle Class, or Rich. And Kristin, one of the big questions we get in the conference room every single day is, how am I doing compared to other people? I know we're probably behind, or I feel like we're a little bit ahead, and there's so many things that come out. And so this article really addressed that. And so when I saw it on the internet, I copied it and I said, we need to use that in the TV show just to let people know. And this article defined economic classes in really 4 ways: poor retirees, middle class retirees. Oh my goodness, do we hear so much about that during a political season? Upper middle class retirees, and rich retirees. And it delineated what causes you to be in each category. Like poor retirees, believe it or not, are lower than the 20th percentile, and they have a net worth of around just $10,000. Now, I know for some of you, 10,000 sounds like a lot. For some of you, 10,000, rightly so, sounds like a very little to have saved for retirement. But there are poor retirees that literally have nothing saved for retirement. And you've heard of that horror story of just living on a fixed income of Social Security for the rest of your life. There are people all around you who are poor retirees. Now, middle class retirees, and this is like the 50th percentile, they have a median net worth of still pretty low, $281,000. And that usually includes things like home equity and retirement savings and 401ks, but just $281,000. Now, for the upper middle class, they've got a range here. And that range is between 201,000 and 608 or 609,000. And it's pretty diversified there, and it's a wide range. But if you're in that 201 to 608, you're literally considered in retirement an upper middle class. And then there's always those people who want to know, well, what are the top people making? Well, at the 90th percentile, and giving you a lot of stats here, but at the 90th percentile, the net worth starts at $1.9 million. So here's what that means. If you have $1.9 million saved for retirement, and in this survey, it also included equity in your home, which many people that are listening to me in Southern California, you do have equity in your home, and it's probably a pretty healthy amount. If you are at $1.9 million, you're considered a rich retiree.
Yeah. And what's so interesting about these stats, I want to go back to the upper middle class range because it was pretty vast. I mean, they're considering your upper middle class if it's between 201,000 and change up to 608,000. That's a pretty significant difference. And yet the article went on to say that the average net worth of folks in retirement is $409,000. So pretty interesting when you look at just the spread, because obviously there's folks' net worth across the board is very varied.
Yes, it's very varied. And Kristin, if you've got $409,000 and you take out 5% per year, which is more than the Monte Carlo model, if you're following just what the big box firms usually follow, that's only $20,500 a year. That's not much when you add that if you only have a Social Security. Now, here's the deal. If you're at 1.9 million, you need a plan because you've amassed wealth and you're in that upper class, you're rich. According to this survey, you're in that rich class. You need a plan so that you don't waste any of it, that you spend it the right way, and you pass it on to another generation in most cases. But if you're at 400,000 and you can only draw $20,000 a year, you need a retirement blueprint. I mean, a lot of people get on the radio, you hear them, and they say, if you've got $2 million, call me, which in essence means if you don't have $2 million, don't bother me, okay? But I'm asking you, if you've only got $400,000, you need to call us and you need to let us sit down with you and build a blueprint so that you can be sure that you're not going to run out of money in retirement. That's what we do on this show. So good article. Thanks for coming in. Thanks for listening. Keep listening. We're going to have 3 more good segments, but now you know where you fit with everybody else.
Yes, and your money's important to you, regardless of how much you have. Like Tom said, there's never been a better time for you to get a plan in place. The team of Mosley Wealth Management would love to be able to work with you to help build a plan that meets your needs and your specific situation. So to claim your complimentary retirement blueprint, all you need to do is call 888-930-5609. We'll be back with more right after this.
Is having $1 million enough to retire? For years, many have considered this to be the goal amount to have for retirement savings, $1 million. But that's the $1 million question. Is that enough for today's modern retiree? Are you sure you've saved enough for a 25 or 30-year retirement? Are you concerned about covering large expenses, including taxes and long-term care? If so, you're not alone. But there is a solution. With a comprehensive financial plan, you can take control of your finances to help you achieve your long-term goals. Call Tom Mosley and the team of Mosley Wealth Management right away to receive your complimentary, comprehensive written financial plan. 888-930-5609.
Call the team at Mosley Wealth Management so we can help you design a complimentary written income plan to help you live the retirement you've always wanted. 888-930-5609. Welcome back, Southern California. You're listening to Right on the Money with Tom Mosley. I'm your host, Kristin Oakley, and today Tom and I are diving back into this important conversation around the biggest hidden retirement costs. We started this conversation last week. We got through 5 of them. We're up to number 6 on our list, which is long-term care. And Tom, I know that this is a subject that it probably doesn't shock anyone. It's on the list of the biggest hidden retirement costs. I know that when you present on this subject live, you have a very important slide that you share at the beginning. And I would love for you to share that with our listeners, because I think that will really help set the context for this discussion.
Kristin, I actually include this slide on every one of my live presentations that we have all over Southern California. And you can go to our website and find out where those live presentations are, and we'd love to have you. But I have this slide that says, warning, the following information has been known to cause anxiety, depression, insomnia, hair loss, high blood pressure, and other symptoms indicating distress, because we're going to talk about money. And in this show, as we did in last week's show, we're talking about those hidden retirement costs and the biggest ones that really knock you down. And the big uncertainty, the big thing that you really just don't know whether it's going to hit you or not, in so many cases, is long-term care.
Mm-hmm.
And in California, there's one company that offers a real legitimate long-term care. There's some indemnity programs and there's some other ways to cover it, but there's one company that really gives you long-term care insurance coverage. And so many people in California, the price is so high, it's so hard to get, that they are really fearful when it comes to long-term care. And Kristin, you are always quick to point out something that I even forget to point out from time to time. And every time we talk about the cost of long-term care,
Mm-hmm.
Medicare does not cover long-term care.
Yeah, and that's such a misconception, and that's why we bring it up. Yep.
I have to say it again. Medicare does not cover it, and you're actually on top of that more than I am, and it's because it just doesn't cover custodial care.
Mm-hmm.
If you say, well, my mom went into the hospital with a broken arm and they put her in a nursing home for about 3 weeks, right? That's skilled nursing.
Mm-hmm.
Where they would put your mom into a facility like that. In many cases, I know my mother-in-law fell, broke her shoulder, broke her arm at different times. Falling is a big part of what happens in the later stages of life. And they would put her into this little home on Harbor up there north of St. Jude's in Fullerton. And they would put her in there, and it was a 21-day maximum stay because it was skilled nursing. But if you ever have a stroke or have something that's really debilitating, and it's something that you cannot stay at home, that's called custodial care.
Mm-hmm.
And Medicare does not cover custodial care.
Well, and here's the hard part is this is according to the U.S. Department of Health and Human Services. They estimate that close to 70% of today's 65-year-olds will require some kind of long-term care for an average of about 3 years. That is a long period of time, and we know the costs are already high and they're rising. But I think what makes this part so challenging for folks is we don't know if we're going to need it or not, right? But we still have to plan for it. That is really challenging to do.
Well, add up the equation. A really high price for it, really hard to get. You have to qualify from a health standpoint. And then I don't know if I'm going to need this. So I'm paying a really high price for something that I might just be putting that money down a hole.
Mm-hmm.
And I might not ever be getting anything back for it. But the statistics come out consistently that 70% of the people who are 65 years of age or older are going to need some form of this care. Now, let me tell you the story of my mom and dad. They're both passed now,
Mm-hmm.
but my mom got Alzheimer's and Parkinson's disease 11 years before she passed away.
Mm.
She was manageable for about 4, 5, or 6 years, but in those last 5 or 6 years, my dad, who was a big strapping guy, and my mom was a little lady, my dad was able to manage my mom. In other words, he, and what's crazy, Kristin, is I got my dad and mom long-term care coverage. They lived in Oklahoma and Texas later on, and I got licensed out there so I could get them long-term care coverage. They had all the long-term care coverage in the world, but guess what? My dad didn't want my mom to go to a nursing home.
Mm-hmm.
So my dad could pick up my mom, put her in the chair. He could take her out of the chair and put her into the car. He could manage her, even though it got really tough for him in the later years as she just was so docile and dormant that she got heavier. So it became harder and harder as my dad got weaker as he got older. Okay, bad story. Okay, sad story. But my dad was able to handle my mom. What I've seen the flip side, though, Kristin, is if my mom had been healthy and my dad had gotten Alzheimer's, my mom could never have been able to do that for my dad. So it's not always the kind of thing that you know which one's going to be hit by it. You don't know how you're going to cover it. So it's really important that you somewhere come to terms with wrestling with long-term care and how are we going to take care of it. Now let's put that together with our first segment where we talked about, the upper middle class even have about $400,000. And if you've got $400,000, you've got to do some spend down. If you're married, if you're single, you got to really spend it down. But if you're married, you've got to spend it down to about 125. If you're single, even more than that, before the state will step in and begin to help you with long-term care. And I know people are going to come out of the woodwork with things where they can get this and you can get that. And there are a lot of services out there, and you need to pursue every single one of them to help and to assist you. But it is expensive, and it's a hidden cost. And as to your point, Kristin, we don't know whether we're going to need it or not for sure.
Right. And it has to be planned for. I mean, let's talk about some of the average annual costs just in California alone. For a home health aide, it's around $82,000 a year. And nursing homes can cost anywhere from $136,000 to $159,000 per year. So even when you think about what we just talked about earlier, the average net worth $400,000, that could get wiped out just like that. And so these costs have to be planned for. So I know we're all about solutions on this show. So Tom, how do you help your clients navigate these costs?
Well, let's talk about the main ways that people pay for it that I've seen. Number one, they pay for it out of pocket. In most cases, everybody tries to do home health care as long as they can before they do nursing home care. Because nursing home is one of the ones that's really going to go up, like you said, $136,000 to $159,000 per year. In 3 years, $136,000 a year will wipe out a $400,000 savings. So paying out of pocket, you need to save for it. You need to have some money set aside, and it's going to really, really impact what you've got. And you know what you're going to do? You're going to pay it. You're going to make sure and take care of your loved one. The other option that a lot of people do is they pursue actual long-term care coverage. And we've said there's a company in California that does still offer it. All the rest of them have fled the state because of the cost of it. But there is a company where you can pursue long-term care. So some of our people, we help them pursue an actual long-term care policy. It could be pretty expensive in the cost, and you'll be paying for something that you may never use, and that alone is going to eat into that $400,000, $500,000, $700,000, $800,000 that you have. So it's going to hit you in a pretty big way when you go that direction. Another way that people pay for it is they set aside some money, and we use a fixed indexed annuity. Now you say, well, wait a minute, here's that annuity popping up. The annuity pays you a monthly payment to help offset the cost of long-term care. And what some people do, let's say they have $800,000 saved for retirement, they may, when they're perfectly healthy, they may put a couple of $100,000 away into a fixed indexed annuity. Now, what will that do for you? Number one, if you ever need money in the future, you can tap into it for income. That comes in particularly handy when a married couple, when one of them passes away and they lose the income of the lower Social Security. So it can pop in for extra income there. Number two, some of these fixed indexed annuities right now have a doubler on the payout if you hit not a nursing home, or not necessarily home health care, but if you hit 2 of the 6 activities of daily living, it will kick in and double the payout. For instance, if you're getting $20,000 a year out of that annuity because of what you put into it, it will double that to $40,000 a year for either spouse if you're married. For you, if you're single, it'll double that from $20,000 to $40,000 for 5 years to help you offset that cost. It's just a perk that they're adding to some of the fixed indexed annuities. Hey, this is where you need a plan, okay? And we build all of this into a retirement blueprint for you based on your situation. You might want a policy. You might want just a plan that you put together, but you need something in place before you need it in place.
We don't want you to be anxious or depressed or worried or scared. We know that this is a lot, but Tom and the team of Mosley Wealth Management, this is what they do for folks. They put together a plan in place to make sure you can navigate through this important hidden cost successfully. So to claim your complimentary written blueprint, again, all you need to do is call 888-930-5609. This is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how they can help and serve you. We're going to dive into the remaining hidden costs in retirement right after this.
Which will you spend more money on in retirement? Food or healthcare? Do you take your investments out of the stock market now that you're retired? How do you know if you've saved enough to stay retired? Will your Social Security check be reduced in the future? How do you produce income from your nest egg to fight costs like taxes and inflation? At Mosley Wealth Management, Tom Mosley and the team take the guessing out of retirement planning by devising a written plan that accounts for all of your concerns. The bigger question, are you going to be okay in retirement? Call Tom Mosley and Mosley Wealth Management for your own complimentary retirement review. 888-930-5609.
Do you know how much you might be paying in fees within your retirement accounts? Just 1 or 2% in hidden fees can eat into your savings and potentially hinder your ability to achieve your retirement goals. But how do you know if you're currently paying these hidden fees, and how do you find them? Tom Mosley and the team of retirement planners at Mosley Wealth Management can help you find the fees within your investments and explore solutions designed to assist with minimizing them. Call for your very own complimentary retirement blueprint and fee review. Let us help work towards finding, exposing, and helping to eliminate those potential hidden fees for you. 888-930-5609.
Get your retirement right on the money with Tom Mosley. Call 888-930-5609 for your no-cost appointment. 888-930-5609.
Welcome back, Southern California. You're listening to Right on the Money with Tom Mosley. He is the founder and president of Mosley Wealth Management, based right here in Southern California, and I'm your host, Kristin Oakley. Before we dive back into our discussion today of the biggest hidden retirement costs, Tom, I know that you mentioned your live events, and you are always busy. You have live events happening throughout Southern California regularly, and folks can actually visit your website to find out when an event might be happening near you. So why don't you share a little bit more about some of the topics that you're going to be covering in these upcoming weeks?
Well, we always through the year cover Social Security, almost because it's 41% of the average American's income in retirement. So Social Security is a big thing we do at our workshops. Taxes are another big thing, particularly this time of year as we're getting close to the end of the year. And then in actual tax season, there's about 6 months where we run a lot of tax workshops as well. Each of those are 1-hour workshops where we really dive deep into Social Security and we really dive deep into taxes. And then we have a retirement masterclass. I just did one this past weekend. That retirement masterclass is about a 2.5 to 3 hour overview of a retirement blueprint. You say, what is that? That we go over income, we go over inflation, we go over investments, we go over taxes, we go over healthcare, and we go over legacy. You've got about a 150-page book that we give out with that that's free of charge just by signing up. Now, my last name is spelled Mosley. There's other ways to spell it. I know my mom spelled hers a different way when she was growing up because her maiden name is Mosley as well. It's just spelled a different way.
Which is so fascinating. I love that story of how your parents got together.
Well, I love to say to tell people I'm a thoroughbred because I'm a Mosley on both sides, okay?
Right.
But it's Mosley wealthmanagement.com. You can go there, and one of the tabs at the top will show you the seminars, and you can sign up to come to a seminar. If you like what we're talking about on this show and you want to talk about some of these hidden cost of retirement, or you want to talk about taxes or talk about your Social Security, you can actually set up an appointment through our website. That's mosleywealthmanagement.com. We'd love to see you in our conference room with an appointment. We'd love to see you in our classrooms all over Southern California where we teach on these subjects. Just go to our website and sign up and come and attend.
Again, the website to visit is mosleywealthmanagement.com. That's Mosley wealthmanagement.com. And as Tom said, you can also schedule your complimentary retirement blueprint appointment by visiting the website as well. Diving back into our list of the biggest hidden retirement costs, this next one on the list, Tom, is one that I think a lot of folks, it's never fun to think about. And also, I don't think folks do enough planning around this because a lot of people aren't aware of all the changes from a financial standpoint that take place when you lose your spouse. And the reality is that going from two people to just one has a variety of hidden costs. So why don't you explain in a little more depth all that needs to be taken into consideration with this hidden cost?
Well, when two become one, almost all of the expenses stay.
Mm-hmm.
You don't get gasoline at the gas pump for half price. Those of you who are single say, yeah, that's me. I understand that. And those of you who are single, no, you've got to pay for that house all by yourself. And when two become one in a marriage, then whatever's left on the mortgage, whatever's left on the upkeep of the house, whatever's left up on the payment on the cars, all the debt stays 100%. But in many times the income goes down. One way the income goes down is in Social Security, because you lose the lower Social Security. It's one of the reasons we work with couples. If you're single, you need to make your social as big as it can be, let it grow as fast and as large as it can be. But if you're married, the one that you need to really emphasize letting grow is the breadwinner, the larger one, because when there's a death in the marriage and there's only one spouse left, the breadwinner, the larger Social Security, is the one that stays. And you've got another big thing that people don't realize. You go from a married filing jointly tax bracket. In almost all married couples cases, you go a year later to a single filer tax bracket. So, for instance, you go into the 22% income tax bracket at a little under or right around $50,000 as a single, whereas a married couple, you go into the 22% tax bracket at around $100,000.
That is such a big difference. And this is why you have to do that tax planning. I think a lot of folks are blindsided by that. It's the widow's penalty, as we refer to it, right?
It really is, Kristin. It is a humongous difference. And again, we say often it's the punch you don't expect. And that's the subject of this show. And last week's show is the hidden cost of retirement. But that's why a lot of times you don't want to carry a big, heavy life insurance policy. But sometimes if you've got still a mortgage and you've still got car debt or even student loan debt, I've got people going into retirement still carrying Parent Plus loans for their child's third master's degree that they paid for, if you understand what I'm saying. And you need to maybe have a life insurance policy that will help the surviving spouse. For those of you who still have pensions, okay, listen up. Be careful the way you take that pension. Yes, it's a larger number just to take it on your life, but if you're married and you go first, that pension goes away. Or if you take 50% to the spouse or 75% to the spouse, that is a big cut when it comes to you going first and leaving the rest of that pension to the spouse. So losing a spouse is going to impact you financially. And so many times what I've seen, Kristin, is especially when a person dies young, and I'm talking about dying in their 60s, many times the person might still be working, and they might be the one spouse that still holds the big time job, and the couple's planning on that money, and boom, they're gone. And not only are they living off of their assets and the life insurance and the other things that we've mentioned, but they don't have that expected income for another 1, 2, or 3 years. At the end of life, most of the time, I've seen a statistic that shows it's 93% of the time, two become one again, okay? And it's the loss of that spouse. It's going to impact the survivor tremendously in a financial way.
And again, not fun to think about, but I know that the most contented people, the people who have the most peace of mind, are the ones who've done this planning, you know, especially whether you're single, of course, the planning needs to be done. But if you're married, it is so important to make sure that plan's in place so that when this does happen, you have a plan in place for it. When you're grieving, that's not the time on top of everything else that you want to have to wade through this and figure this out. And it's already so overwhelming. And I think the financial considerations, if those can be buttoned up ahead of time, it can make a world of difference on a situation that is not pleasant for anyone to have to go through. And so again, this is why we're talking about this, spending so much time on it. For women, this is particularly important. I know you and I are both passionate about financial education for all people, but especially from the female point of view, we are living on average 5 to 6 years longer than husbands. And we need to have that plan in place. If that plan hasn't been done, guess what? It's the woman who's going to be finding out if the plan that was done actually works for her. And so again, we can't stress this enough. It's really important to plan for this hidden cost in retirement. I know this also feeds right into the next hidden cost we're going to talk about, which is downsizing. And typically, a lot of times folks are doing this while they're still married, but downsizing could also happen after the loss of a spouse, correct?
Correct. And it's a big financial issue because there are expenses in selling your home. There are expenses in moving to a smaller one. First of all, you got realtor fees. You're going to have to sell your house and buy another one. So you've got double realtor fees. Number two, you've got moving costs. You're going to have to move. And when you're 65, 70, 75 years old, usually you don't want to rent the U-Haul and do it yourself.
Right.
And so, you're going to have to hire somebody to move. And then if you buy a new place, you're going to want to make it yours. You're going to want to personalize it with colors, and you're going to want to do some upkeep. Maybe if you buy an older place, you're going to want to maybe rip out the kitchen, rip out a bathroom, make it yours. If you buy a brand new place, you're going to have to do the window dressings. So all of these, imagine this little cash register over here just going off. You've got to continue to do that. And then as you get older, what I do see is people take money out of their IRAs and 401ks, and they renovate their house for their, let's call it, their aging needs, okay?
Right.
Because, sometimes somebody won't always pay for a ramp for you. You have to buy the ramp yourself because you need the wheelchair, or your spouse needs the wheelchair. And I've seen bathroom doors have to be widened because the wheelchair won't get into the bathroom. And
walk-in showers, right?
Walk-in showers, maybe redoing the shower so that you don't have to step over 12, 15-inch into a 12 or 15-inch tub that you step down into, and you have to step over to get into it. So many things. And again, Kristin, hear the cash register going off. So that downsizing, though it might save you money, is just going to be a cost that you need to expect. And if you move to another state, there's also the 2 realtor costs and the things that you don't expect are going to hit you. They're hidden costs that come from downsizing. And as we talked about earlier in this segment, so many times the losing of a spouse also is tied to a move or a downsize. So you need to realize that can be a double whammy that comes at you. Hey, what's going to happen in your life? I don't know. But here's what I do know. You need to be working with somebody who's compassionate, who's understanding, who understands more than just finance, than just dollars, but is able to help walk you through these things. I've been doing this 29 years. I've got 7 advisors that we do this on a daily basis, help people walk through the issues of retirement. You need a blueprint. If you don't have one, call us and get on our schedule today. We'll develop one for you.
That number to call to claim your complimentary retirement retirement blueprint is 888-930-5609. Or again, you're also welcome to visit us online at mosleywealthmanagement.com. That's MOSLEY wealthmanagement.com. We know that a lot of this might be new to you. The good news is it's not new to Tom and the team of Mosley Wealth Management, and they are here to help you successfully navigate to and through each of these hidden costs in your retirement. We'll be back with more right after this.
With today's rising interest rate environment, have you considered refinancing your retirement? When interest rates go low, you might be able to refinance your homes, your car loans, and even your credit card rates because it could help you keep more of your own money each month. When interest rates go up, it may make sense to refinance your retirement. Higher interest rates could provide income opportunities that you may not be aware of. What works for your portfolio during low interest rate environments may not work for you in a high interest rate environment. So find out if a retirement refi could work better for you. Don't look down at today's higher interest rates. Find out if a retirement refi could work for you. Call Tom Mosley of Mosley Wealth Management at 888-930-5609. That's 888-930-5609. With rising interest rates, it might be time for you to refi your retirement.
Call Tom Mosley and the team at Mosley Wealth Management for your complimentary retirement blueprint. 888-930-5609. Welcome back, Southern California. You're listening to Right on the Money with Tom Mosley. I'm your host, Kristin Oakley, and today Tom and I are continuing our discussion of the biggest hidden retirement costs. We've got two more that we're going to get through on today's show. Next up on the list is family support, and we're defining that as financial help for adult children or grandchildren, which can include all sorts of different costs, right, Tom? I know you've seen it all.
I've seen it all, and I've also seen a situation, and I want to caution you about this. In most families, you who are retiring out there or close to retiring, or you're in your 50s and you've got the nest egg built up, a lot of times there are family members, I hope it's not yours, but there are family members who see you as the bank, you know, as the money bags, as the piggy bank that they can go break and take anytime they want. And I always have been able to caution my people. They don't always take my advice, but I always caution people sometimes, you are the goose that lays the golden egg for the family. In other words, you have the money. And I have so many people that their kids, and this particularly happens, Kristin, in one event that takes place in a family, and I'm trying to be careful the way I say it here. Usually when one of the mom or dad pass away and there's just the mom or dad left, and sometimes I've seen kids, maybe not yours, I hope not yours, that are, if you're out there, but they almost use that as leverage to put pressure on the surviving parent to loan money or to give money, and they almost treat it like it's my way of, if you'll give me money, I'll come see you. If you give me money, I'll be nice to you. And I've even got situations like that in my own kids, where sometimes, as long as I'm giving money, they're nice to me. If I stop giving them money, they stop being nice to me. And I've had to put some guardrails in to be careful, because family support is something that I wholeheartedly believe in. And just to show you, for instance, and I'll delve a little bit into my own personal experience here. Within the past 2 years, I've had 2 different children go through tough times financially. And they needed a large chunk of money to save their house. And I offered in both cases to buy in as a portion of that house, because I don't have $100,000, $200,000 just to throw around, if you understand. I don't light my fireplace with $100 bills,
right.
Kristin. and so I offered in both cases to buy into the house and own a portion of the house. Therefore, when it's sold and it appreciated, my money would still grow. Okay. And it would be a tremendous help. Well, one child rejected that. and rejected me because I wouldn't just give them the money. And another child took it because she was going through a divorce, and she was able to stay in the house with the 2 small children, which I thought was really, really important. So you need to differ. Here's what I would tell you. When you're supporting family, and it can come from all kinds of different ways. It could be education costs. It could be, in Southern California, the only way your kids are going to get into a house, you're giving them or you're loaning them a down payment on a house. It could be an unexpected situation that they didn't cause, that just happened upon them, an emergency or something that just hit them out of the clear blue. Be really careful the way you give money and you give help. And here's what I've encouraged people to do, and I've practiced this, and it's worked out well. Clearly delineate whether the money that you're supporting that family member is whether it's a gift or whether it's a loan. And if it's a gift, make clear that it is a straight gift. There's some guidelines as to what you can legally give every year. There's some strict guidelines. Married couples can give twice as much because it's one individual to one individual. One married couple giving to a married child can do 4 gifts, if you understand what I'm saying. Each one of the parents can give to each one of the children in the marriage. So
but without incurring, like, you hit the gift tax limit, but yes, there's opportunities there, right?
Right, Kristin. I don't think anybody's ever, to my knowledge, ever been called on that. But just so that you stay within the guidelines, if the IRS, with 80,000 new people out there scrutinizing tips and everything else that they've decided to go after, you've got to be really, really careful. But clearly delineate it's a gift and make sure you stay within the guidelines. Or I encourage you, if it's a loan, draw up a document, have it notarized that it is a loan. And will that stand in court? You're not going to take your kids to court, but it teaches your children that there's no such thing as a free lunch, or it is a free lunch, if you understand what I'm saying. It clearly makes everything there. So many families split up emotionally and in relationships. We're coming up on the holidays, and there's so many families. It's probably politics is the biggest divider now, but financial issues have divided more families than I've ever seen in the 29 years I've doing this than anything else until just recently. Now, politically, people are divided, but be careful. I want you to support your family. I think you need to support your family, but you need to have some guidelines and to make sure that you're not just blowing what you've got. Make sure that somebody's not taking advantage of you. Be careful about putting a child on as a co-signer on your accounts at the bank. Be really careful with financial family support, but be generous and open to helping your family at the same time.
Yes, and that can be a fine line to walk. But again, this stresses the importance of having that solid plan in place. And this is why you can't just send someone a retirement blueprint. It's not a cookie cutter, cut and dried approach. Every situation's different. Every family's different. You might have different goals, different needs, and how you need to plan for all these things we're talking about. And so this is why your complimentary retirement blueprint will be completely customized and personalized to you and your situation. Well, we have time for one more on this list, Tom. The 10th one over the last 2 weeks that we need to talk about is insurance costs.
Yeah, you got to be careful. It's challenging. You still need insurance. You still need premiums for Medicare. You say, Medicare, I thought it was free. That's Part A.
And it's not free for everybody either, right?
It's not, yeah.
There's some exceptions there. So yeah.
There's some exceptions if you didn't work long enough, if you didn't work the right way. We help a lot of people who are legal immigrants into the country, and they've come here and they've worked, but they haven't worked the 10 years. So they might not get Medicare A. They might have to buy it themselves. So be careful. Know that before you retire. Know that before you stop that job. What kind of insurance cost am I going to have for the insurance insurance of Medicare, and be careful for your dental coverage. And you might have a lot of dental work that needs to be done. I always encourage people to get that done before you leave your job.
Yes.
And do that on the group policy. And you're going to have home insurance. And I don't know about yours, but mine goes up, on a regular basis. It goes up like the temperature does in Cabo in August, if you know what I mean. It just continues to go up. Auto insurance, it's actually the kind of deal where people and some companies go up higher on auto insurance for people who, as they get older, because they can prove that people who are older get into more accidents and it's more costly. So just, and here's another thing, an umbrella policy. You might have enough assets, because there's a lot of people who are unscrupulous out there and they just look for people to sue. And you might have enough assets that you need to pick up a $300 or $400 a year, $1 million umbrella policy in case somebody just comes out of the clear and sues you. Long-term care. I'm tired here just talking about all of these, all right?
Mm-hmm.
I know sometimes people pick up our show and listen to it. You want to move to Florida, okay, that's great. But look at the cost of home insurance in Florida with all the hurricanes that they've had in the past 4 or 5 years. Right here in Southern California, some people in Yorba Linda and Anaheim Hills are being dropped from their home insurance because of the fire danger.
Mm-hmm.
And so it's never going to go away. There's always going to be insurance costs, and many times they're going to get higher and higher and higher as you get older. So not trying to scare you, just trying to tell you, you got to be careful. Auto insurance is expected to increase in California, according to one report that I read, by 50% over the next 2 years.
Wow.
And so every single time I look at mine, it goes up. I just got my taxes on my home. They just went up. The insurance on my home. And I have been with this company for 29 years. I've been with this company. They just went up on mine pretty significantly. So you've got to be careful for your insurance costs. So, just hidden costs. You say, well, what about this hidden cost? I didn't cover them all. Okay. But I did cover some of the biggest ones that are out there. What do you need to counteract these? Kristin, everybody out there needs a retirement blueprint.
Yes.
It's a plan where you look at every area. You look at income, you look at inflation, you look at investments, you look at taxes. How are they going to impact your finances? You look at healthcare, you look at your legacy and how you're going to leave it. Those 6 things are included in a retirement blueprint. What it does is it addresses each one as to where you are. That's why we can't start without you. That used to be a fast food chain's, moniker, that they don't start without you. Well, we can't start the blueprint without you. You've got to call. You've got to get on our schedule. But what it will do is it will give you a plan for retirement so you can know for sure you're not going to run out of income the rest of your life, and you're going to pay as little as you're legally required to pay in taxes. Hey, call and get on our schedule. Come see us.
If any of this has you feeling overwhelmed, the good news is there is hope. There is a solution. And as Tom said, it starts with getting your very own complimentary retirement blueprint. Let the team of Mosley Wealth Management remove the overwhelm for you. To start your complimentary retirement blueprint, again, 2 ways to connect. You can call 888-930-5609 or visit us online at mosleywealthmanagement.com. That's MOSLEY wealthmanagement.com. Hey, thanks so much for joining us this weekend. We appreciate you being here. Be safe, be happy, be blessed, and we look forward to being back with you next week here on Right on the Money with Tom Mosley.
Investment advisory services offered by duly registered individuals through Mosley Wealth Management Incorporated. Mosley Wealth Management and Mosley Insurance and Financial Services are affiliated companies by common ownership license number OB61811. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refers to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength, claims paying ability of the issuing carrier. This content is intended for for informational and educational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the needs of an individual situation. All hypothetical examples are provided for illustrative purposes only. They do not represent real-life scenarios. Mosley Insurance and Financial Services, nor its agents or representatives, may give tax or legal advice. Individuals should consult with a qualified professional for guidance before making any investment decisions. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. Some of the information provided may be from one or more third parties, which we believe to be reliable sources, but accuracy and completeness cannot be guaranteed by Mosley Insurance and Financial Services.